£500,000 in business profit, the most tax efficient way to build wealth long term and take cash out now. So this video is made because I was sitting down with some entrepreneurs the other day and we were discussing how to take out money from our businesses the most tax efficient way for cash now and building wealth long term. And in summary, we came up with this conclusion. So there was one entrepreneur there who was on track to make £550,000 worth of operating profit this year. And we came to this conclusion about their business. So if you're in a similar position, number one, congratulations, you've got a successful business. So for that particular business owner, of course, the first thing to do is to take out the pension allowance. Now, she hadn't taken out her full allowances every year. So she was able to take out, I can't remember, I think it was 120,000 in pension allowances because she had contributed some towards the pension earlier years. But you can do up to £180,000 if you haven't put in your full allowances of the last 3 years. But let's say you have done a decent amount of pension contribution, you can put in £60,000 per year before any corporation tax is charged or before any other penalties are charged by HMRC. So from your £550,000, £60,000 go to pension contribution and you're stacking that for the future. So everything we're going to talk about here is not only building wealth or taking out cash now, but it's also stacking wealth for the future via pensions and building wealth long term. So the £60,000 has gone to your pension allowance, which you can access at the time of making this video. It's probably going to be by the age of 57 at the earliest for most people watching this video. So after the £60,000 of pension contribution has gone from £550,000 of profit, you've got £490,000 left over. Now, I want to jump all the way to the end first because you need to live and you want to live a decent life, especially if you've just made £550,000 in business profit. But in the UK, there are some tax traps that you can fall for if you are extracting too much money. And remember, when you're making that much money, 550,000, 1 million, 2 million, 3 million in profit, your biggest enemy is tax. By far, the biggest enemy is tax in terms of taking money out of your pocket. So you really need to think about tax more than anything else. Let's say that £100,000 is the number which is perfectly fine for you to take out. And when you're taking that out for yourself as a business owner, you want to take that out via a 12,500 salary and the remaining amount through dividends, because that's going to be the best way or the most tax efficient way that you can take money out of your business. And for the purposes of this video, we're going to say that £100,000 is more than enough for you to live for the remainder of the year or for 1 year. And we'll park that to the end now. So you're going to take out £100,000 for yourself as living expenses. So out of your £490,000, you can play with £390,000, but you need to make sure that at least £90,000 is left over after corporation tax has been charged. So let's play with this £390,000 now. So with your holding company structure, you can charge a management fee and you can move £390,000 into another company. And what you'll do there is that you can actually invest that in other activities. So if you move the money around, you can invest it in ideally either property or your own business. They're the only two things that I would actually suggest moving it into. You can invest into stocks and other investments as well. You can do money lending if you're into that kind of thing. But property and your own business is probably the easiest, most tension-free way to invest your money. Stocks is as well, but you have to pick the right stocks. So that's the other situation. Or you can invest it into index funds as well. That's another area that you can do it where you don't have to actually worry too much about the performance of your portfolio. The best thing to do is to invest it in your own business. And the way you make that decision, whether you want to invest it in your own business or not, is that if you can make a return of 20% or more without scaling your business too much or adding operational complexity, you should invest that money or reinvest that money into your own business. Because the likelihood of you getting a higher than 20% return in property or a higher than 20% return in stocks even is quite difficult. It's probably more possible with stocks, and if you're flipping properties, then you can actually do it with property as well. But reinvesting into an asset that you already know how to run, You already have a team, you already know the operations, you already know the customers. All you have to do is, for example, reinvest it into marketing. And if you put in, 100,000 in there, you're going to get 150,000 back. That's a 50% return on your investment. Then that is the safest place to actually reinvest your money, or the best place to reinvest your money. So always think, can I reinvest this money into my own business? If the answer, and you get a 20% or higher return. If the answer is no, then it's possible that investing into stocks or investing into property is going to be your best bet. And the reason for investing into property or stocks is because, and why you should look at anything less than 20%, even though the investment from stocks or properties might be lower than even 15% and maybe even lower than 12%, is because you don't have to have operational complexity with property, and you don't have operational complexity in stocks or in the index funds at the very least. So then you can move this money around and you can buy a property and you can put that property on rent, or you can move this money around and put it into an index fund, and that index fund will grow over time. And that might get you a 5% return, it might get you a 10% return, it might get you a 12% return. In some cases, it might even get you a 15% return. And that's how you can build wealth long term, because now you're using your business as a vehicle to grow your money via your own business or via property or via index funds. Different people like different ways of investing their money. Some people lean towards property and like property. Some people lean towards index funds, and some people want to invest in individual stocks. And that's up to you. Whatever you have higher competence in, you have more education on, and you know that you have confidence in your investment strategy, you should do what's right for you. So that's one of the ways to move out the money. Another way that you can actually reinvest the money is to buy another business in your industry. That's one of the things that I talk about all the time, is buying and selling businesses. And buying businesses in your own industry is a way that you can actually get returns of 30% or more. And buying a business has its own pros and cons. But the pros, if you're buying within your industry or something which is adjacent to your industry within your sector, ideally, is going to give you a massive moat around your business. Because let's say, for argument's sake, you are in the business of accounting and you buy another accountancy firm. So currently you're doing bookkeeping and your clients are asking you for tax advice every single year. Of course, if you're a business owner, you want to have tax efficient advice for your business, and you're going to go to your accountant for that. And let's say you can't currently provide that information to your clients. The best thing to do is to go and buy another accountancy firm that specializes in tax advice, and you bring that into your own firm, you bring that within to your holding company structure, your group of company structure, and now you can service clients not only in bookkeeping but also in tax advice as well. And therefore you can keep the revenue yourself. Generally speaking, you can get returns of anything from 25% upwards when you're buying another business. So that's also a great way of investing your money, which is not directly in your own business, but also it's adjacent to your other business as well. It's adjacent to your current business. So now you've got property to grow your wealth, or you've got index funds to grow your wealth, or you've got stocks to grow your wealth, or you can invest it into your own business, or you can buy another business. Now, coming to the end, coming back to cash extraction right now. So once you have extracted 100,000 from your business as a owner, from a 12,500 salary and the remainder in dividends. So as per the new tax rates, you'll be left with £78,200. Let's just square the number of £78,000, that you'll be left with £78,000. Remember, dividends are taken after corporation tax, so you would have to have paid the corporation tax as well on the remaining amount. But remember, those wealth building activities that we've already done, we've factored in that we will need to be left with about £100,000, so we can take that in salary and we can take that in dividends. So you're left with £78,000. Now, the first thing that you should do with £78,000 is you should put £20,000 into an ISA. Whether you put that into, well, now you can only put up to £12,000 per annum per year into a cash ISA. So you would have to put the remaining £8,000 into a stocks and shares ISA. But if you've got an emergency fund for yourself, your personal life, and as a business owner, I would say 6 months plus is ideal. If you're an employee and you've got a stable job, then maybe they talk about 3 to 6 months worth of emergency fund. But as a business owner, 6 months is the minimum. So work out what your 6 months worth of expenses are, and whatever that is, then you should put that into a cash ISA, or you start building that up over time anyway. So £12,000 go into a cash ISA. Now, if you've already got 12,000, or let's say you've got 6 months worth of expenses saved up as a personal individual, then the remaining is to put that 20,000 into a stocks and shares ISA, because over time the stock market gives the best growth out of all different types of investments. That's what's the case. And with ISAs, all of the returns of both dividends and capital growth is tax-free. So remember, of £500,000 of business profit, your biggest enemy is the taxman. So you want to ensure that you're investing it into as many tax-efficient strategies as you can. So £20,000 goes into an ISA, and that leaves you with, if it's 78,000, obviously that's left with £58,000. So £58,000 works out at roughly, well, not roughly, exactly, I'm just doing it on the calculator here, right here, £4,833 per month. So now you've got £4,833 a month to live, and you should be able to live a decent lifestyle on that. You're not top 1%, but you're definitely in the top 10% of income earners in the country. And not only what you're doing is that you're living a comfortable life right now, you're investing into ISA, which is going to give you returns both in dividends and long-term growth through stocks. And you're going to do that every single year. So of course, over time, you'll be building up a nice little wealth pot, both personally and through your pension as well. But also you're getting now returns from your business. If you've invested into property, you're getting returns from that property. And remember, when you're investing in a holdco structure, let me just talk about this. I don't know if people know about this or not. When you have a holding company structure, you have one holding company which owns subsidiaries. So your holding company owns your business and the property business and maybe another business, and all of these can move money around each other. They can all move money around each other tax-free through management fee structures and tax-free dividends. And that's why having a holding company structure is extremely tax efficient for business owners, especially if you're doing a decent amount of money. So I had a holding company structure all the way from when we were just had £70,000 in profit. Now we're much further ahead than that, and the holding company structure allows us to move money around and invest the money where we need to. Tax-free, that's the key word. If you want to find out more about what you can do with your business profit, but also how you may want to exit in the future, then continue watching videos in this channel, and I'll see you in the next video.